turn back to the markets to an investment strategist who isn't surprised that stocks couldn't hold on to earlier gains today. William Greiner is the president and chief investment officer of Scout Investment Advisors, which has $7 billion in assets. In early May, when many investment strategists said stocks would advance, he said the market had already made its gains for the year. And now he says a sluggish economy could send stocks even lower. Bill, thanks for joining us. Let me ask you to chime in here on this little debate that Carol has set up there with Neil Ferguson and Paul Krugman. Do you think that the U.S. economy needs more stimulus? Will we get more stimulus, or do we just continue to sort of slug along here, as you put it, without any extra money?
Man, I think that really the stimulus issue comes down to what the stimulus is going to be used for. What I mean by that is that the reason you would lever up your balance sheet to move money to your income statement is because you think the multiplier effect by that move is going to be very, very positive, greater than 1.0 to 1. If that's going to be the case, then spending money on roads and infrastructure and those kinds of issues, I think, makes a tremendous amount of sense, whereas moving money from your balance sheet to your income statement specifically just for income enhancement, let's call it, and transfer payments probably doesn't make as much sense. So in my opinion, it really comes down to what you're going to spend, or what the government's going to spend the money on, whether it makes sense or not. You know,
it's actually a great point, and Neil Ferguson made that point earlier in his interview with Eric Schatzker, saying that some budgets looking for austerity like Greece are really just masochistic and suicidal, whereas others, like the British budget, leave room for growth, which is, of course, what you want. You aren't very optimistic when it comes to growth going forward. I mean, you don't see a double-dip recession, Bill, but you think that we're going to see really subpar growth.
Yeah, we do. We're in that great camp right now. It seems like this is becoming a fairly crowded camp that believes the economy is going to continue to grow, but it's going to feel awfully recession-like. Now, the thing to look at here, I think, is nominal GDP, which is the GDP we all look at, real GDP on a quarter-by-quarter basis, but basically factoring back in inflationary pressure. So it's pricing plus unit volume growth, if you want to call it that. And that number is probably going to be sub 3% for the remainder of this year. Usually when the economy's nominal GDP growth rate is less than 3%, that's very much recession-like. 3%, or the nominal GDP is very akin to corporate revenue growth rates. And when those growth rates are less than 3%, people don't hire, people don't spend a lot of money for capital goods. The economy tends to go sideways for a while.
How do you expect that, Bill, to... Sorry, Carol, go ahead.
No, that's okay. Forgive me, Matt. I do want to jump in because I'm listening to this conversation. And, Bill, you know, you're talking about subpar growth. And certainly Paul Krugman, who just talked to, you know, he's expecting subpar growth here, too. At the same time, we've got a lot of folks saying, you know, the market's really cheap right now. They're looking at valuations. I mean, what's the right argument to follow at this point? If we have subpar growth, who cares if the market's cheap?
Well, you need a catalyst, Carol, to kind of move the market away from being cheap. The market can stay cheap for a long period of time, like an individual stock can stay cheap for a long period of time, unless you have a catalyst that really moves that needle as far as people gaining interest in the asset class. You're not going to see a lot of movement. You can say the same thing about sentiment. Right now, sentiment's lousy. And usually when you have bad sentiment coupled together with good or a low-priced market, that eventually leads to the market starting to move on the upside, which I think is probably going to happen sometime later in the year. But right now, I just don't see the catalyst is going to move the needle.
What if we drop below 950? Because I notice your range is about 950 to 1150 now. If we do get to see S&P 900, is that a sign that people should go in and buy?
Well, I think we get to 950 as long as earnings expectations and earnings estimate revision isn't particularly worrisome, which I think is a problem right now. But if that's not a particular worry for people, then I think stepping up to the plate and trying to find some good quality companies when the market's right around 950 probably makes a lot of sense. You know, high quality companies out there don't get to a position of deep valuation discounts, but when they do, you step up and buy them, and over the long term make quite a bit of money.
All right. Hey, Bill, I appreciate you coming by, stopping by for a few minutes. Bill Greiner there from Scout Investment Advisors.